Okay, let's dive in. We've got a stack of sources on the table today, and we're focusing on something pretty fundamental that's undergoing, well, a massive transformation: real estate.
That's right. Specifically, one of his biggest traditional challenges,
Yeah,
the illiquidity and how technology and smart financial structures are changing the game entirely.
exactly. And our primary source material gives us the perspective of Dr. Pooyan Ghamari, a Swiss economist, founder of the Eland platform. He's got some really insightful views, it seems.
Yeah, on how real estate is evolving,
Yeah.
moving away from that classic slow brick-and-mortar asset into something, well, more like readily tradable stocks.
So our mission for this deep dive is to really pull out the crucial nuggets from these sources. We want to understand the how and the where of this change.
How is this illiquidity problem being tackled?
Right. We'll look at tokenization, special purpose vehicles, SPVs, and then where is this really taking off? We're going to look closely at Dubai and Switzerland.
It's worth remembering what real estate has traditionally been like. I mean, it's stable, sure,
Yeah.
but so illiquid.
Oh, absolutely. Buying or selling takes months, right?
Sure.
Sometimes
The
minutes.
costs, huge transaction costs, the bureaucracy is just immense.
Yes. All of that restricts access for a lot of investors, makes it incredibly difficult to react quickly if you need to adjust your portfolio.
Or even just bring in capital efficiently.
Yeah.
It's tough.
It is. And that illiquidity, while maybe it offers some stability, prevents those flash crashes you see elsewhere.
Well,
It definitely comes at the cost of speed and flexibility, a major hurdle.
yeah, especially for attracting, diverse capital. So this fundamental slowness is really the core problem this whole transformation is trying to solve.
Which leads us nicely to the two main pillars highlighted in the sources that are underpinning this shift.
Okay.
Pillar number one, tokenization.
Right. So tokenization, at its heart, it just means taking a real-world asset like a building or maybe specific rights tied to it
Uh-huh.
and representing it as a digital token on a blockchain. Simple concept, really.
But powerful. So this token isn't just like a digital picture. It actually represents something tangible.
Exactly. It can represent, say, fractional ownership or maybe an interest in the rental income, other defined rights. The key thing is it takes something indivisible,
Like a whole building.
right, and makes it divisible, digital, and crucially, potentially tradable.
Okay, and this is where we start to see some really impactful benefits, these nuggets we're after.
First one, fractional ownership. Instead of needing, millions to buy an entire building.
Which most people don't have.
Exactly. You can now potentially buy tiny units of that building, represented by these tokens.
That completely changes who can invest. It democratizes access, doesn't it?
It really does. Suddenly, high-value assets, think prime commercial real estate in London or New York, aren't just for the institutions or the super rich.
A much broader range of investors can get involved with much smaller amounts of capital. That's huge.
And that directly fuels the second benefit, enhanced liquidity.
Because these tokens can be traded.
Potentially, yes. If they're listed on digital asset exchanges, you could trade them. So you take a process that normally takes months
The traditional buying and selling.
and you shrink it down, potentially, to minutes or hours. That's a radical shift.
It's like comparing stock market speed to, well, waiting for lawyers and land registries. Massive difference.
Then the third nugget is increased transparency.
The blockchain aspect.
Right, because ownership and transactions are logged on this immutable blockchain ledger. It's all verifiable, resistant to tampering.
Which should, theoretically, reduce fraud and maybe cut down on disputes and the costs associated with them.
That's the idea. And finally, there's global accessibility.
How so?
Well, digital tokens aren't really bound by geography in the same way physical property deeds are. This potentially opens up seamless international investment.
So someone in, say, Asia could easily invest in a property in Europe via tokens without navigating all the complex cross-border legal stuff directly.
That's the promise. It simplifies things enormously.
Okay, tokenization sounds pretty revolutionary on its own. But as the source material points out, it's not quite the whole picture, is it?
No, exactly. Just having a digital token floating around isn't enough. You need a proper legal and regulatory structure around it, especially for real-world assets like property.
Right. The real world has rules.
It does. And that's where the second critical pillar comes in, special purpose vehicles or SPVs.
Okay, let's break that down. What exactly is an SPV in this context?
So an SPV is basically a separate legal entity, often a company, maybe a trust, set up for one specific purpose.
Which is?
To hold the underlying asset,
Mm-hmm.
the actual physical property. So when you buy the tokens, you're actually buying a stake or rights in that SPV, not, strictly speaking, a direct piece of the building itself.
Oh, okay. So the SPV acts like a container for the asset.
Precisely. It's the essential legal wrapper.
Yeah.
That provides some key advantages. First, legal clarity. Crucially, SPVs are usually set up to be bankruptcy remote. This means the asset inside the SPV is legally separate, ring-fenced from the financial problems of whoever originally put the property in there.
Got it. So if the original developer goes bust, the property in the SPV and therefore the token holder's investment is protected.
That's the principle. It offers investors a much more secure legal foundation. It isolates the asset.
And that isolation, that's important for securitization potential too, right? Like mortgage-backed securities.
Exactly the same principle. By containing the asset and its income stream, say, the rent within the SPV, you can package those cash flows into tradable securities.
Which is what attracts the big players.
Absolutely vital for bringing in large-scale institutional capital. Pension funds, sovereign wealth funds, they understand and are comfortable with securitized structures.
Okay, makes sense. What else does the SPV do?
It massively helps with regulatory compliance. It gives a clear, established legal framework for actually issuing the tokens or managing investor relations.
Things like KYSAC-UML checks.
All of that. It's much harder to manage compliance properly with direct, scattered, fractional ownership of a physical asset. The SPV provides a central point.
And presumably simplifies management too.
Yeah, definitely. The SPV typically handles the property management, distributing income to token holders, overall governance. It centralizes everything for the investors.
So it's a combination that's really powerful here.
That's the synergy. Tokenization brings the digital layer, visibility, transparency, speed.
And the SPV brings the vital legal and structural layer, makes it legally sound, compliant, securitizable.
And investable for institutions. Together, they bridge that gap between the physical, illiquid asset and the liquid digital financial world.
Right. But as you said, this transformation isn't happening uniformly everywhere. The local environment, especially regulation, is key.
Hugely important. And our source material, particularly Dr. Ghamari's insights, points to specific jurisdictions that are really enabling this.
Two leaders mentioned are Dubai and Switzerland. Let's start with Dubai, described as the Agile Innovator.
Yeah, Dubai's made a very clear strategic push to be a global hub for finance, tech, and real estate. And they've been remarkably quick, really agile in embracing digital assets.
What are their specific advantages here?
Well, first, progressive regulators.
Yeah.
You've got the DFSA and the DIFC free zone, for example, proactively creating frameworks for digital assets. They're not waiting around.
And it's generally known for being business-friendly, isn't it?
Very much so. Low taxes, great infrastructure, easy to set up shop. Plus, the real estate market itself is dynamic.
Meaning?
Strong growth in certain areas, attractive rental yields. It pulls in a lot of international capital. It's often seen as a safe haven. And their immigration policies also keep demand high.
And there's a government push behind this.
Absolutely. Things like the Dubai blockchain strategy, the Land Department exploring blockchain. It signals a clear top-down commitment. It fits their wider goal of diversifying away from oil, and digitally enhanced real estate is a core part of that vision.
Okay, so that's Dubai. Fast, dynamic, forward-looking. Then you have Switzerland.
The bastion of stability and precision, as the source puts it. And given Dr. Ghamari's Swiss background, it's natural this is highlighted.
Switzerland's reputation is built on finance, stability, discretion, regulatory quality.
Right. And while some might see them as cautious, they've actually been quite forward-thinking on digital assets. Their DLT Act from 2021 is a prime example.
What did that do?
It provided really clear legal definitions, explicitly recognizing securities issued on distributed ledgers. That legal certainty is a massive draw, especially for institutional money that needs clarity.
They've also got the financial expertise, right? The talent pool.
Deep expertise, especially in complex financial instruments, cross-border stuff. Plus, that reputation for investor protection and economic stability really counts for a lot.
And the whole crypto valley scene in Zug.
Yeah, that's a big factor too. A thriving ecosystem where tech, finance, and regulators actually collaborate. It fosters innovation within a stable framework.
So it's an interesting contrast. Dubai offers speed, dynamism, and emerging market feel.
Very agile, yes. While Switzerland offers, perhaps, unparalleled legal certainty and this really mature, trusted financial infrastructure.
Which makes Switzerland potentially ideal for structuring those robust SPVs, especially for complex deals or high-value assets.
Exactly. That focus on legal clarity and trust is paramount if you want to bring traditional finance comfortably into this new digital asset space.
Okay, so we've got the pieces. Tokenization, SPVs, supportive jurisdictions. And bringing these together creates the potential for what the source calls bankable futures. What does bankable mean here?
Yeah, bankable basically means making these tokenized real estate investments attractive, reliable, ultimately fundable by traditional capital sources. We're talking banks, large investment funds, insurance companies.
Getting the mainstream financial world involved.
Precisely. How does this setup achieve that? Well, first, standardization and transparency.
The SPV standardizes the structure.
Right, makes it easier for institutions to analyze. And the blockchain's transparency, combined with proper reporting through the SPV, gives them the verifiable data they need for due diligence.
Okay. What else makes it bankable?
Well, securitization through the SPV can also include things like credit enhancements,
Like what?
over-collateralization, maybe guarantees, things that improve the credit rating of the tokenized securities, making them safer, more appealing to conservative investors.
Right, lowering the perceived risk.
And the SPV structure allows for different types of investment within the same property. You can create different classes of tokens.
Like equity and debt.
Exactly. Some tokens might represent equity, offering potential upside and rental income. Others might be like debt, offering fixed payments. So you can cater to different risk appetites, just like in traditional bond markets.
That makes sense. More options attract more investors.
And a really crucial factor for bankability is developing a liquid secondary market.
The ability to actually trade these tokens easily.
Yes. If investors, especially big ones like pension funds, know they can easily sell their tokens on a digital exchange, that provides a clear exit strategy. It overcomes that huge illiquidity problem of traditional real estate.
Gives them the flexibility to adjust their holdings quickly.
Which they need.
Yeah.
And finally, by packaging these assets into transparent, tradable tokens within a solid legal structure like an SPV.
It opens the door to global capital.
Yeah, pools of capital that might find direct cross-border property investment way too complex or risky otherwise. This is really relevant for emerging markets looking to attract foreign investment into their real estate.
And the source mentions the ALIN platform's goal is essentially this, building these bridges.
That's the idea Dr. Ghamari puts forward, building bridges between tangible real estate and digital innovation to create opportunities that are both accessible and bankable, meeting that demand from investors looking for diversification and efficiency.
And that point about underlying demand, like from immigration policies in the UAE, that strengthens the actual asset value, which ultimately underpins the whole bankable structure.
Absolutely. The best structure in the world needs a solid underlying asset.
Okay, moving beyond those core mechanics, the source material also dives into some broader forces. There were some interesting nuggets in the FAQ section analysis.
Yeah, some wider context, like looking at macroeconomic indicators beyond the obvious stuff.
What should we watch for?
Things like a sustained drop in housing starts and building permits, that signals issues with future supply, developer confidence may be waning.
Okay, what else?
A significant withdrawal of foreign direct investment, especially from countries that have historically poured money into a particular market. That can be a red flag.
And looking at more granular data.
Right, things like household debt-to-income ratios creeping up, rental vacancy rates rising consistently, or a growing gap between how fast incomes are rising versus how fast property prices are rising. These can be early warnings.
Interesting. The source also touches on de-dollarization. How does that connect?
Well, the push by BRICS nations, for instance, to trade more in their own currencies could reshape global capital flows.
Meaning less money going into dollar-denominated assets.
Potentially. And maybe more capital flowing towards emerging markets within that sphere. Think places like Dubai again, or Riyadh, Mumbai, certain African capitals. This could create new demand, new appreciation potential there.
Offering diversification away from the dollar system.
Exactly. And maybe an inflation hedge in those non-dollar zones. Another point was strategies for high net worth individuals in downturns.
Go beyond just waiting it out.
Yeah. Things like looking for distressed assets, buying from motivated sellers at a discount.
Or focusing on niche sectors that tend to hold up better.
Right, like data centers, logistics, healthcare properties, multifamily housing. They often have more stable demand. Also, considering structured debt investments or adaptive reuse projects, converting old offices to apartments, for example.
Makes sense. What about central banks? Beyond just interest rates.
Oh, yeah. Quantitative easing, QE. Pumping liquidity into the system that tends to inflate asset prices, including real estate.
And the reverse. Quantitative tightening. QT.
That pulls liquidity out, tends to cool things down. But also important are those macroprudential tools. limits on loan-to-value ratios, how much you can borrow against a property's value, or debt-to-income limits, bank capital requirements for mortgages.
So rules that directly control how much credit flows into the property market?
Exactly. They can be used to curb speculation, try to improve affordability, maintain stability. They're powerful tools.
This source also mentioned AI. How's that playing out in real estate?
It's moving beyond just tracking trends. We're seeing more predictive modeling.
Using lots of data to forecast prices.
Yeah, really granular data, satellite imagery, social media sentiment, you name it, to try and predict market shifts more accurately.
And then prescriptive AI, telling you what to do.
Kind of. Recommending optimal timing for buying or selling, estimating ROI on renovations, automatically flagging potentially distressed assets, optimizing large portfolios, even spotting arbitrage opportunities. It's getting sophisticated.
Looking ahead, what about risks? The source mentioned potential regulatory risks around 2025.
Yeah, a few things to watch. Possible changes in property ownership laws, maybe new taxes or restrictions on foreign buyers in some places.
Sustainability mandates, too.
Definitely. Growing pressure for green buildings, potentially requiring expensive retrofits for older properties. That's a cost factor.
And for the digital asset side specifically.
The big challenge is still fragmented regulation globally. Different rules for security tokens, for AML KYC, consumer protection. It's not harmonized yet. And this idea of tech sovereignty, where countries want more control over digital platforms, could complicate cross-border operations.
Finally, geopolitics. Always a factor.
Always. Instability creates uncertainty, right?
Yeah.
It can lead to capital flight from volatile regions.
Which might create distressed buying opportunities for those willing to take the risk.
Exactly. But it also triggers a flight to safety. Capital flows towards stable hubs, Zurich, Singapore, maybe Gulf cities, again, pushing up values there.
So savvy investors can potentially play that volatility.
If they have the foresight and agility, yes.
Yeah.
It's complex, though.
So weaving all this together, what does the future landscape actually look like? Where is this heading?
Well, there's still hurdles, for sure. Getting global regulators on the same page is a big one. Developing really robust, trusted ways to value these fractionalized assets. Integrating smoothly with the existing financial system.
Not insignificant challenges.
No, but the opportunities are huge.
Yeah.
We could be looking at a future where micro-investment in global real estate is truly mainstream. Anyone with a small amount of capital could potentially own a diversified portfolio.
That would be transformative.
And think about smart contracts, automating property management, collecting rent, paying maintenance bills, distributing income instantly to token holders.
Taking out the middleman, streamlining operations.
Yeah. And AI moving beyond just analysis to actively optimizing portfolio performance. Plus, maybe using tokenization to transparently track ESG goals, attracting specific types of capital.
So the core idea we've explored here, it's not just tweaking the edges, it's a fundamental re-architecture.
Absolutely. A re-architecture of how real estate is financed, owned, and traded. And places like Dubai and Switzerland, as our sources highlighted, are actively building the ecosystems to make this happen.
Okay, so we've taken a pretty deep dive into this source material, pulled out some key nuggets, I think.
Yeah, we've seen how tokenization and SPVs, especially when supported by the right regulatory environment like in Dubai or Switzerland, are tackling that age-old problem of real estate illiquidity.
Creating potentially liquid, bankable opportunities, opening things up to more diverse capital.
And we've touched on that wider context too, the macro factors, geopolitics, the role of AI, all shaping this evolution.
Right. So maybe here's a final thought for you, the listener, to chew on.
If real estate, traditionally seen as this really solid, anchored, maybe the least liquid major asset class, if that's becoming easily divisible, potentially highly liquid, globally tradable, what does that actually mean for your concept of property ownership?
Yeah, how does that shift maybe influence how you think about building or preserving wealth in the future? Something to consider.